Ladies and gentlemen, thank you for standing by and welcome to the Healthscope Financial Year of 2015 full year results. At this time, all participants are in listen-only mode. There will be a presentation followed by a question and answer session. At which time, if you wish to queue for a question, you will need to press 0 followed by 1 on your telephone. I would now like to hand the conference over to Mr. Robert Cook. Please go ahead.
Thank you very much. Welcome to the call, everyone. I want to allow plenty of time at the end for questions, and I'm very pleased to deliver Healthscope's first full year back as a listed company to you this morning. I'm going to do a slide turn, but we'll a page turn rather, and so hopefully you do have those in front of you. And we'll talk to most of the slides, and as I said, allow a lot of questions at the end if they're there. So first of all, on the next slide, which is the financial highlights, obviously we've delivered an operating EBITDA of 383 million, which is 0.3% above prospectus forecast. An operating EBIT, again 0.8% above prospectus forecast, and an operating NPAT of 153.1 million, which is 4% above prospectus forecast. So overall, we're pleased that we were able to deliver on what we said we would, and continue with the momentum across many of the business areas, particularly around labour, procurement, and we'll talk later about the brownfields and the greenfield hospitals that we have underway. Obviously, there's a robust operating EBITDA and operating EBIT growth at a group level, so we continue to see that as we have over the last few years, with operating EBITDA growth of 8.7% and operating EBIT growth of 9.4%. There's strong growth from continuing operations at a segment level. Operating EBITDA from continuing operations is 10%, and operating EBIT growth from continuing operations is 11%. Hospitals EBITDA increased by 10.4%, with a margin uplift of 80 basis points. International pathology EBITDA increased by 13.7%, with a margin uplift of 120 basis points. And our medical centre division EBITDA increased 0.3%, with EBIT increasing 16.8%. We continue to see strong cash generation with a cash conversion ratio of 97.3%, and we will be declaring a final unfranked dividend of 3.7 per share, taking the total FY15 dividend to 7 cents per share in line with dividend policy. I'll now turn to the operational highlights. The FY15 result demonstrates how organic business is in great shape, and this will continue. And going forward, organic growth will be supplemented by growth from hospital expansion projects that are currently well underway. Operational strategies around case mix, labour and procurement continue to deliver, and they underpin our results again in FY15 with the margin uplift of 70 basis points. Our leadership for quality and clinical outcomes is now continually being acknowledged. We continue to promote the transparent reporting of quality outcomes, and you will recall that in February 2012, Healthscope was the first group in Australia to publish on its website, and continues to do so, a number of clinical indicators so that the public health funds government can see how we are tracking and how we are continuing to improve. We welcome health funds' increasing interest in pay-for-quality initiatives, and we understand the debate on quality. We think that we have led this discussion over the past 4 years, and as I said, we're the first to not only publish, but also continually track the improvements that were being made. We are the ones who initiated placing it into the health fund contracts. We are happy to back ourselves and our clinical performance against best practice benchmarks, where they are based on clinical evidence. We continue to have strong relationship with all funds, including Medibank. We understand the commercial pressures funds are under, as well as hospitals. We understand the challenge of sustainability and affordability. So in many ways, not a lot has changed. Obviously, the public debate, which has centred around quality in the private sector, personally, I think it's not helpful because the quality of the private health sector in Australia is second to none. If you compare it not just with the public sector, but also internationally where those comparisons can be made, we are more than pulling our weight in terms of quality in this country and in this sector. Nonetheless, we will continue to back ourselves to continue to find ways to secure long-term relationships with all major funds. Moving on to our hospital expansion program, projects are on track with those under construction or approved expected to deliver close to 1,000 new beds and over 50 operating theatres by the end of FY18. And I do need to come back to make sure that there is an understanding in the market of when these open and their impact during the construction phase, when we commission them, and when obviously the beds ramp up, but all on track, and we'll come back to that theme later. All these projects are focused on large acute facilities in eastern seaboard states. In other words, in areas where the population growth and private health insurance penetration are most robust. The Northern Beaches construction is proceeding as planned. We also, in the last 12 months, were awarded the contract to provide pathology services to the Greater Wellington region in New Zealand. We now hold 13 of the 20 District Health Board contracts in New Zealand. During this reporting period, the first week of July, we divested our underperforming non-core Australian pathology operations for $105 million. I'll now hand over to the Chief Finance Officer, Michael Samuels, who will take us through the group performance.
Thanks, Robert. I'll take you to slide 7, which summarises the group result for the FY15 year. Just in terms of making you familiar with the format of our results, the group result represents the continuing operations of hospitals, medical centres and international pathology, plus the closed and divested Australian pathology operations. But our result for the year was underpinned by strong growth in hospitals and international pathology, revenue up 4.8% to $2.4 billion for the year, operating EBITDA up 8.7% to $388.3 million, a 50 basis points improvement in EBITDA margin, working its way down to an operating net profit after tax of $153.1 million. That falls out at an EPS of 8.6 cents per share, and as Robert's mentioned, a strong cash conversion of 97.3% of EBITDA. You will see there that there are $12.2 million of non-operating expenses. They primarily relate to first the closure of our Queensland pathology operations in February this year, and then followed on with the divestment of the balance of Australian pathology completed in July. Obviously, we have a different capital structure in place since the IPO on July the 28th. So if you look at the interest of the finance cost line, that accounts for that point of difference there, just fundamentally a different capital structure. If you adjusted our FY15 result pro forma basis to reflect the current capital structure through the 12-month period, you'll find we have a pro forma operating net profit after tax for FY15 was $173 million, and the reconciliation for that is in Appendix 3 in the pack. In slide 8, in more detail, we just reconcile the result against the prospectus. Obviously very pleasing to be able to deliver on the prospectus promise, and as you can see there in the table, at pretty much every line we're either on or slightly better than prospectus, with an operating net profit after tax of $153.1 million, 4% above the prospectus. Appendix 1 to the pack shows you the performance by the respective divisions against the prospectus forecast, and again you will see all those results line up really well, but I don't intend to go through those on this call, but it's in Appendix 1. Slide 9, I guess, really focuses us on the core business of hospitals, international pathology and medical centres on a go-forward basis. So continuing operations is the terminology that you'll see through our accounts there. And I think what's really pleasing here is that we've been delivering consistent growth in profit and margin growth over the past 4 years through a number of strategies centred around revenue, case mix, labour and procurement, whilst delivering our Brownfields building program on the way through. So summarising the result here, revenue up 5.8% to $2.1 billion, operating EBITDA up 10% to $380.8 million, 70 basis points margin improvement, working its way down to an operating net profit after tax of $155.6 million, cash conversion at 99.2%, and you'll see $1.9 million of non-operating expenses there relating to tender and acquisition costs and the divestment of Brisbane Waters Hospital, which was completed in July 14. Appendix 2 just shows the detail of the bridge from the group results to the continuing operations results. On slide 10, just summarising EPS and dividends. Our dividend policy is to pay 70% of net profit after tax. Our final FY15 dividend is based on a pro forma net profit after tax, adjusting for the interest expense from July, old capital structure under private equity, and non-operating expenses. And again, Appendix 3 takes you through that calculation. Declaring the final dividend of 3.7 cents takes up to 7 cents per share for the year. The dividend is unfranked due to our carried forward tax losses, and the dividend payment dates are shown on the table, with the dividend being paid on September 29. On slide 11, just summarising some key metrics from our gearing and capital expenditure. You'll see there our net debt of $958.8 million, reflecting today's capital structure. That number does not include the $92.5 million of cash proceeds received on the 6th of July from the divestment of the Australian pathology operations. Our net debt to EBITDA was 2.47 times EBITDA, but again, that does not include the $92.5 million cash received in July. Interest cover ratio of 8.55, and in terms of capital expenditure there, what you see very clearly there is the material investments that we're making in Brownfields projects. Robert will talk more about those projects a little bit later on, but $362 million CapEx all up, of which $275.9 million was growth CapEx, primarily Brownfield hospital projects. We've got comfortable headroom in all banking covenants. I'll just remind you that the banking covenant details are articulated in the prospectus, and just to remind you that the project finance debt packages for Northern Beaches and Gold Coast do not get included in those covenant calculations, so we have very significant headroom in terms of bank covenants. We'll now just take you to slide 13 to briefly walk you through the divisional results. Just in reminding us, hospitals is the engine room of the business, delivering 81% of EBITDA, revenue growth of 5.7% to just over $1.8 billion of revenue, 10.4% growth in EBITDA, and 80 basis points margin improvement, continuing that trend of margin improvement over prior years. The revenue growth is really driven by obviously admissions, case mix and price changes from health funds. To remind us, this is largely an organic growth result, with only 23 beds opened over the last couple of years, but in parallel to that, we have been building major capacity which will come online from FY17 and beyond. And just to repeat, we do have a number of key sites that are capacity constrained, hence our volume growth has been constrained, which really goes to the heart of the Brownfield projects that are under construction. The EBITDA growth and margin lift is really pleasing, and as I said to you, that really represents a continuation of strategies that have been on foot for the past 4 years. Direct sourcing has been progressing well, and that sets up a platform to continue to expand that product range. Our hospital Brownfield projects are going as planned, and as Roberts has already highlighted, we feel we continue to lead the industry on quality initiatives and accreditation, and through accreditation, achieving 8% met with merit accreditation ratings from ACHS in FY15, which is 4 times the industry average of 2%. So quality remains a key feature of our hospital portfolio. Taking to slide 14, international pathology, where pleasingly another strong performance from that really important division. Revenue up to 243.2 mil, 8.5% growth. EBITDA growing 13.7% to $60 million for the year, and 120 basis points improvement in operating EBITDA margin to 24.7%. In just circling through the countries one at a time, these statistics are expressed in local currency, but New Zealand, revenue up 5.5% and EBITDA up 9.5%. The growth is really driven from the full year impact of the DML business acquisition completed in October 2013, and we were awarded a new contract in Wellington. The new contract is effective from November, but we stepped into the current operating contract from May 2015 there, and as is the nature of pathology, where you've got more volume, improving laboratory efficiencies and procurement efficiencies is a key part of the margin improvement. Singapore delivered a really good year, with revenue growth continued from specialists and commercial contracted markets, and we continued to work away at efficiencies there in Singapore. And likewise in Malaysia, which had modest revenue growth but strong EBITDA growth, and they continue to be really strong footprint, and I think we've got about 1,000 people on the ground up there in Southeast Asia in those two businesses. On slide 15, following the divestment of Australian pathology with pooled medical centres was reported as part of that segment. It's now its own segment, and as you can see there, a solid result from medical centres for the year. 15 million operating EBITDA, but importantly, operating EBIT growth of 16.8% to $8.7 million, which is primarily the reflection of a policy of the last couple of years of more working of GPs on the split arrangements to encourage them to work at Healthscope rather than writing large cheques to buy them into our medical centres. So a good little business. Australian pathology there on slide 16, you can see the numbers there for what it is. As we've said for quite a few years, the business was principally non-core, underperforming, and the divestment of the remaining operations was completed on the 6th of July. With that, I will hand back to Robert to take you through our strategy update.
Thanks, Michael. So I'm now on slide 18. I think it's pleasing to report that this strategy slide has now been out into the market for more than 3 years, and we're delivering to that strategy, and the strategies have also shown some insight into how the market might move, particularly around growth and quality. So we're pleased with the strategies and where we're at. So just quickly walking through each of the different boxes. On organic, we continue to build strategies around occupancy, utilisation and cost management, which continue to deliver. And as I've said already, these have been the drivers of our improvement over the last 3 or 4 years. There's a number of brownfields and relocate and grow, which are on track, and I'll cover these off in more detail. So FY15, and certainly the first half up until probably next Easter of 16, there's major constructions occurring at several of our prime sites. These have been really well handled because despite the best planning in the world, things do go wrong during construction. There is disruption. Doctors, patients, they love the new buildings, but they don't like the construction. And we're talking about serious and major construction at several of our major sites. So I think our staff have done an excellent job in delivering consistent results, even with jackhammers and trucks coming in and out of the place all the time. We really will start to see, and we've talked about, and we're happy to reconcile later, close to 1,000 extra beds at what I would classify as Tier 1 facilities and 50 operating theatres that will be delivered by the end of FY18. There's also a good pipeline or a second stage of projects that are well advanced in planning, and some even have DAs in place. And I might use the Gold Coast Stage 2. So already our management team up there, they've recruited several young obstetricians, new services, and they're already putting some cases forward, that we should hit the go button on an additional 60 beds, which we have the planning permit for. So there's a really good pipeline being developed, particularly around those Tier 1 hospitals. The landmark Northern Beaches project is well underway, and we're hopeful that this will lead to further opportunities down the track. There is no doubt the public system is under increasing pressure, which is a positive for the private hospital operators. And I might use an example as recently as last Monday, the Victorian Health Minister revealed the hidden waiting list to see a specialist doctor in a public hospital can be more than a year, and then you add the time to the public waiting list, which are published. And there's already talking about a scheme where waiting list in Victoria for ENT at Bendigo Base Hospital is 469 days, and at the Austin Hospital it's 31, and moving patients around the state. Other states, and Victoria is included in that, are looking at some outsourcing of private work, and we've seen that in Queensland, Tasmania and Victoria in the last 12 months. It's certainly not an avalanche yet, but politically, to keep building and resourcing public hospitals when you have this totally socially unacceptable 1, 2, 3 year wait for things that go to quality of life, we do see that as expanding in future years and an opportunity for us. In international, we continue to explore a number of opportunities, particularly in Malaysia, Indonesia and China, and we remain confident that we could deliver on a joint venture, a management contract or some other model, and we certainly have some active projects under consideration, and we've had our team up there several times in the last 6 months. We also have focused, now that Australian Pathology is no longer a member of the team, we have time to focus on some smaller acquisition opportunities, particularly in Malaysia and to a lesser extent Singapore and throughout Asia. We have a really good platform to create a much bigger Asian pathology business. Now moving to slide 19, and I think the purpose of this was to nothing like a photo to preview what we're doing. We haven't been asleep at the small facilities of a Tier 2 or Tier 3, as I refer to, and a lot of the focus has been about lifting the acuity. So there's obviously Campbelltown, 2 operating theatres, Newcastle, a theatre and an ICU. Sydney Southwest, one of the issues for us was the doctors having confidence to do major surgery and leave the patients there for a longer period of time. We've opened an ICU. We're just about, also not on this list, about to open an ICU at Geelong. So whilst they're small projects, they're all focused on lifting the acuity and giving the doctors confidence that we can do more complex cases at those facilities. Next slide, on slide 20, there's some of our prime sites have got significant works underway. So obviously Knox, Norwest and National Capital, those projects are well advanced and they'll all be up and running, certainly Knox and National Capital early calendar year 16, and Norwest will be about 6 months after that. The Northern Beaches is on track, Holmes Glen is on track, and as I said, we've got some other minor projects, John Faulkner, Geelong, Nepean and Darwin. All up, there's, I should also mention, just single out the 3 largest projects. So we've got the Northern Beaches Hospital, which opens in FY18, and the 2 relocate and grow projects. So the Gold Coast will open next Easter, but in the way of planning, and I think you've seen with public hospital openings in Brisbane and Perth, we can't afford to get this wrong. Doctors need the confidence that in the lead up to the relocation, we will wind down significantly, and equally the week or 2 after we relocate, we won't hit full steam for some time. So that's factored into our budget for FY16, and obviously when you factor in several of those brownfields and the impact, we'll get to guidance later, but you can expect that, we've got some challenges to keep the run rate going, but we're confident that we will meet those challenges. But in 17 and 18 and beyond, we get the use of all those beds and all the hindrances of building works out the way at most of our sites. The other thing that I just wanted to sort of draw your attention to, that these hospitals are in the epicentre of growth in Melbourne, Sydney and Brisbane. We have facilities elsewhere, but we just can't get the growth to work because the population is pretty flat in a lot of those other places. So we are, in housing terms, location, and we're now building the extra room on the house to accommodate for the expanded family that's coming our way. 21. Again, just to sort of show you the progress, so you see the Gold Coast there. It's still several months away from opening, but you can quite clearly see, it's up and running. I think what people don't realise, unless you've been to that site, there is a 750 public hospital that opened about 18 months ago. There's a university, a tram line, and they're building the Commonwealth Games Village, all within a kilometre. And again, we're at the epicentre. So for doctors and patients, convenience, and obviously with our focus on quality, the way that we've designed the facility, we're very, very confident that that will be a big success story for us. Home Queen similarly, in an area of Melbourne where it's currently serviced by 3 very small facilities. So from a doctor's point of view, all of a sudden you have at your local doorstep a hospital that will have a full range of services and brand new rooms and accommodation. And Nepean again is another one that we probably haven't publicised enough, but again a really good growth area of Sydney, co-located with a public facility, and we're seeing some major expansion occur there, not just in terms of beds and operating theatres, but also the infrastructure that goes around, from car parking to kitchens and all sorts of things that we're also doing. Page 22, there's some other projects that the board have now approved, and for different reasons we're yet to hit the go button. John Faulkner, when I write my memoirs on trying to get a permit for a building in Victoria, will make interesting reading. We're again awaiting the Minister of Planning's decision following an exhaustive and lengthy community consultation process, but we remain confident we'll get that one through. Sunnybank, North Park, Frankston and Brisbane, we're confident that we'll be able to hit the go button on those in the next 6 months or so. International pathology. New Zealand's been just a great success story for us over the last 3 or 4 years. We continue to win contracts as they come up. There's not many more to come up. The ones that we have, the biggest ones, Auckland and Greater Wellington, are locked in until at least 2020 and 2025 respectively. We obviously are working very closely with the DHBs, and we provide more or less an efficiency dividend model where we continue to get improvements in our margins, but obviously we're prepared to share some of that with the local health authorities. Singapore, the market's growing strongly, and we're targeting increased penetration of specialist, commercial and hospital markets that tend to attract a higher fee. We've continued to invest in laboratories, which will lead to further operating efficiencies. Malaysia, we expect our growth to return to market. There were some government changes last year, including a GST on healthcare and other things that sort of saw for a softer market, but we still had good growth. And again, we're confident that that market has some small acquisition opportunities going forward. Medical centres, I think for the last 3 or 4 years, it was too tied to our Australian pathology business. We've now separated it. It's a good little business in its own right, and I suppose the question for us is, how do we take a good little business into a medium-sized business? So we have a number of strategies where we're confident there's further consolidation, and we think that our model is pretty user-friendly for doctors. It's corporate medicine, but without the feel of corporate medicine, and we think that's the attractive to a lot of GPs who are looking for a different model going forward. So now turning to the summary and the outlook. So we you feel like delivered on prospectus forecast. It's always to say I'm glad I can say that, and I understand the repercussions if I hadn't been able to say that. It wasn't a walk in the park. I think the number was, it was the right number, and I think our results prove that we've done slightly better without the benefit of real growth that is yet to come. So there's a lot left on the table for our existing shareholders and future shareholders that will come from that growth and continuation of our existing strategies. We're seeing robust group results and operating EBITDA increase and EBIT increase. The commitment to quality, I feel that we're well positioned to continue to highlight to health funds in particular, and to doctors and nurses, and ultimately patients and government, that we are prepared to put our results out there. We're prepared to back ourselves in, but we want a financial model that encourages us to continue to improve, not penalises us. The growth phase is the significant upside of Healthscope, and from day one, you've heard me say that location. Our tier one hospitals, many are full, and even despite these brownfields, there's still several like Melbourne Private and Prince of Wales Private, which remain without a brownfield strategy, which are full most days of the week. So we have further opportunities, but some of those are a little bit harder to execute from a DA and a planning, but we certainly are working overtime to free up some additional capacity at other sites where we are full. We've mentioned about the strong cash flow and the balance sheet to support what we might want to do in the next few years, and I'll now take you to the last slide on outlook. So FY15 has been a successful year for Healthscope, and our revenue strategies, combined with our cost strategies around labour and procurement, will continue to deliver further improvements in FY16. During the second half of FY16, we'll also commission some large capital projects, namely Gold Coast, Knox Private and National Capital in Canberra, which will lay the foundation for accelerated growth in FY17 and beyond. So I'll open up for questions and just sort of summarise by saying we're pleased with the result. I don't want to say boring is good. Hopefully it's boring plus a little bit. But the real exciting bit for us is that you can walk around and see all the operational efficiencies, and you can now see a lot of cranes, and you're seeing those cranes in locations which are already have a preeminent position in their local communities, and we think that the extra capacity we're adding in will fill a much wanted need for that extra capacity to stop people travelling into the city or being underserviced in the public system. So on that note, I'll hand back to the moderator and invite questions.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. If you wish to queue for a question, please press 0 followed by 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press 0 followed by 2. And our first question comes from the line of Matthew Pryor from Evans and Partners. Please ask your question.
Good morning, Robert and team. Congrats on hitting the numbers. I guess, Robert, just given you haven't given guidance for fiscal 16, and you've talked about Gold Coast, Knox, National Capital, they're about 165 net new beds, which is about a 4% increase, but I appreciate they're in a higher cost, kind of overhead facility base. So can you give us a sense as to whether your ongoing initiatives and mix procurement labour can offset the drag in second half 16 or in fiscal 16, given that you're able to drive EBITDA at double the rate of revenue in fiscal 15? Thanks.
Yeah, the short answer is there's still upside in all of the strategies that we've been pursuing for the last 4 years, centred around revenue, labour and procurement. There is still upside there. As Robert's talked about, there is some impacts that we will walk through as we appropriately commission new facilities and beds. And on the way through, we'll continue to grow the business in terms of top line, bottom line, and margins.
I suppose guidance is fraught with danger, and we haven't put a number out there deliberately. All of our strategies for the last 3 or 4 years around case mix, procurement, labour, same. So they've got a long runway. Some of them have got a decade in terms of procurement. We're still, I think, got a lot of work to do, and we're still seeing the same rate of improvement that we have for the last 3 or 4 years. I think we're just being a little bit cautious because it looks like some in the field or who look at the company have just assumed that there will be no disruption from these building works, that they will open on day one, they'll be full on day one, and that's just not reality. And I'll use the Gold Coast. So it is on track to open next Easter. It's actually a couple of weeks ahead of schedule. But the 2 weeks before we relocate 200 odd patients, obviously if you're a doctor, you're not going to book a patient in. You may delay, a lot of orthopaedic, a lot of surgery. So we will deliberately, in conjunction with our doctors and the confidence, run down the occupancy of that facility. And equally, when it opens on day one, there won't be 200 patients in there. It will take a couple of weeks to ramp back up. So for that particular facility, there's probably a 6-week period at least where its occupancy will be 50% what it is, on a traditional basis. In FY17, we've got the use of all those extra beds, and I'll be sitting here, being a lot more bullish about, where we get to. But we just want to probably just put a caveat on it. National Capital and at Knox, we're breaking through existing operating theatres at Christmas. We're scheduled that, and the doctors will, be reallocated in additional theatres. But we're reducing our capacity for probably 6 or 8 weeks in operating theatres at Canberra and Knox whilst we undertake those works during the Christmas period. So you can probably, we did put in the outlook that's same, but I just wanted to sort of say don't get ahead of us and put those beds in too early. I think it'll be a very, very different discussion here in 12 months' time because I'll have the benefits of several of those projects already up and running, and then a couple of other big ones, including Holmes Glen and Northern Beaches about to open. So the future's still really bright, but I was just a bit concerned that if you did the back of the envelope and you assume that the beds would open, some people may get ahead of where we might land.
Sure, and I guess just one follow-up question, Robert. Given we've seen this with kind of IHH and other hospital operators that have opened a lot of capacity in big chunks, how much line of sight do you get in terms of filling that capacity to the extent of, you mentioned some obstetricians that you've already lined up, how far in advance of opening do you tee up specialists who then obviously somewhat commit or give you an indication as to theatre time that they will utilise so you do get kind of confidence and line of sight? How far in advance do you get that?
We get it at least 18 months before the project opens. So as part of our business case, I might use Sunnybank as an example. We approved an initial couple of $1 million to do a high-level feasibility, walked around, saw a number of doctors. Our Queensland State Manager, our building manager, walked around with the hospital operator, and we got a sign-up for a number of sessional suites, a commitment. And then that gave us, obviously, the strength to build a business case around the additional operating theatres and beds that we would need. Similarly, on the Gold Coast, in our internal magazine, there's a picture of 5 very young female ONGs who are currently only working in the public, and we've started taking bookings now, obviously, starting to hold the doors open for next March. So it's not like IHH. It's not build it and they will come. It's... I suppose Norwest and Knox are a bit different again because we've got an emergency department. We know we can fill it, but it mightn't be high acuity. So obviously we spend a lot of time working on making sure that the mix going in is the mix that we want. But at each of the sites, we look at least, I'm going to say 18 months out with hardwired names and commitment before we put a shovel in the ground.
Okay, great, thanks. Just one last one from me. You just mentioned mix and optimisation of mix. Do you see the trend in, obviously insurers and the new kind of style of negotiations impacting your ability to drive mix going forward?
No, look, there's a real lot of noise. Not much has changed. Yeah, we saw growth this year in cardiac and orthopedics at sort of closer to 10%. There was a 3% drop in obstetrics that basically went to the public sector, people trying to avoid some real heavy out-of-pockets. But while we continue to build operating theatres and ICU, the waiting list is for elective surgery in the public sector. So that waiting list is our best friend. As much as, without health funds funding those products, they wouldn't have a product. So, you get some noise about, reductions in length of stay. Psych and rehab the rules are always being challenged. But at the end of the day, there's pretty insatiable demand for those specialties. So, we understand the problem that the health funds have got in trying to fund ever-increasing demand and an ageing population and all those things. But my job is to continue to provide the facilities to treat those patients who need that sort of work.
Great, thank you.
Thank you. And the next question comes from the line of David Stanson from CLSA. Please ask your question.
I wonder if you could perhaps step through on a year-by-year basis, as much as you're able to, the timeline for these 50 operating theatres to calendar year 18. I'd be interested if you could confirm firstly that in F15 we had six new operating theatres, or brownfield operating theatres opened. Thank you.
So I was trying to find a... David, I'll come back to that in 1 second. We'll take one more question just while I'm...
Sure, so 1 second.
Yep. A very accurate answer.
Yep, so perhaps, I know that you're not going to give guidance, but perhaps
Here we go.
one from...
I've got it right in front of us. I thought you might ask me that one. David, I will put a caveat on. Don't forget the beds, all right? I know the theatres are important, but don't forget the beds as well. So we're seeing in August this year now, we're opening 4 ICU beds down at Geelong. In late October, November, we'll be opening 3 operating theatres at National Capital. I'll skip over the beds. 1 operating theatre at Nepean. In February 16, 2 at Darwin. And this is net new, right? So Gold Coast is a relocate and grow 3. We're going from 10 to 13 on stage 1, but there is plans for more. At North Park and ED, which obviously fills the theatres. Holmes Glen in November 16, 8. Sunnybank 2, November 16. Norwest is an extra 3. April 17, we get Frankston with 2 and John Faulkner with a day's surgery. In FY18, we get John Faulkner with another 2, Brisbane with 4, and obviously Northern Beaches with 20. Which, if my maths is correct, should add up to about 50.
Perfect. Thank you very much. And my last question, I know you're not giving guidance, but if you could give us any colour on, perhaps Michael could give us some colour around, F16 interest compared to 15 and tax rate, and perhaps a CapEx number that we should be working towards for F16, that'd be greatly appreciated. Thank you.
So let me start the easy one. The effective tax rate will be just shy of 30 cents in the dollar. It presents a fraction higher than that in 15 because of the July interest component and breaching thin cap requirements. In terms of growth CapEx, we've invested $273 odd million in FY15. You can probably expect that number to double into 16 as we execute the Brownfields program, and in particular Northern Beaches. And on the way through, obviously, there's an interest component that will follow the level of investment, but it won't be wildly different to our actual experience in FY15 if you take out the anomaly of the July capital structure.
Great. And we should be thinking about a maintenance CapEx in line with F15?
Yeah, you shouldn't see any material change in that number.
Thanks very much.
David, just to return to the operating theatre too, nearly every one of those is either co-located or has its own emergency department. So these things are linked for us.
Great. Thanks for making that clear.
Thank you. Our next question comes from the line of Greg Colley from Macquarie. Please ask your question.
Hi guys, thanks for taking my questions. Can you hear me okay?
Yes.
Great. First of all, on international expansion, it seems you're taking a relatively cautious approach. Is it fair to say that the strategy remains in terms of a capital light or management contract type structure?
Yeah, the strategy is very capital light. You know, the people that we're talking to, you know, they're looking to either have existing facilities or they're looking at government contracts. And I think I was quoted in the paper correctly the other day saying the opportunity for us is to bring our operating expertise. Obviously, we see some opportunities with pathology and education component. And, you know, we train 3,000 undergraduate nurses through our hospitals with some pretty tight relationships with universities, and obviously procurement where we would see the right partner helping us to accelerate the direct sourcing project. So a bit disappointing. I probably haven't got a little bit more to reveal today, to be honest with you. But yeah, obviously we think we've done a thorough search of potential partners, and some of those we're still very much engaged with and starting to get into the nitty-gritty of, you know, how a partnership might look going forward.
Okay, great, thanks. And then just last question for me on quality. I mean, you guys already have quality metrics in your contracts with insurers. I guess the question is, how different are some of the metrics which one of the large insurers is now trying to, I guess, incorporate into its broader contracts? And is perhaps the challenge here getting alignment of those metrics?
Yeah, look, I'm going to be a fence sitter and sit on the side of the Minister for Health. We published our data in early 2012 off our own bat. Bupa then supported that with a quality payment regime, and we've now expanded that to 2 other funds, including Medibank, with a sort of hybrid version. But our system had 3 distinct components. The first one that we do publish on the web, and Ramsay are the only ones that have followed us. So, you know, we would say to Medibank and everyone else, let's see the data, let's see who is doing what. And if you get on a Healthscope website, you can see that. So the transparency bit, I think, is being lost in this debate. The second thing is that we have 17 never events, as we call them. Now, Medibank would refer to them as mistakes. So we said with Bupa that if we left a surgical instrument in, operated on the wrong side, you know what, that's a pretty serious mistake. That's clearly our fault. We shouldn't get paid. And I'm more worried about our health medical malpractice insurer than I am about Bupa or Medibank. And that was a sign, you know, and our premiums have come down. So the mistake bit for us is 17. We have 24 clinical indicators where we want to improve, but, you know, Medibank's list, which they've now published, so I can now comment, I might use MRSA. A patient in a nursing home is very likely to have a higher incidence when they come in. So if that patient comes in, then we're not paid, you know, under their regime, and you sort of go, well, hold it, we want to improve the system. That's not a mistake, that's a part of the system. So we should see what the infection rates are, see what our contribution is, see what we're doing to improve it. But as for giving you a guarantee, short of screening Medibank members at the door, I can't do that, and I shouldn't do that. So I think the Quality Council is much better placed than Medibank or even an individual operator than Healthscope, and we will 100% lock in and publish whatever the indicators are that body ends up coming out with in December. So for us to talk to Medibank, and look, I think some of the rates in the industry have been quoted that, obviously because of our high quality standards, we wouldn't be impacted financially as much as some of our competitors, and some are quoting a 2 or 3% impact if they accepted that 165. So I endorse what Medibank's trying to do, but I think the implementation of it has got a few flaws, and I think that the Minister's involvement will be good because it will sort out those flaws. And I think people at the end of the day will see what a great job we do. And to talk about all the mistakes, I think, is putting a wrong flavour to the great quality that occurs in this sector. Just one last thing, Greg, too, just while I'm laying down the challenge to Medibank. I'm happy to sign up into the transparency and take it to a new level. But they haven't talked yet. 2 out of 10 Medibank members today are being treated as private patients in public hospitals. So we assume that the contracts will roll to all providers for their members, not just some selected private groups. If they're genuinely concerned about the quality that their members are getting, you would hope that the 20% were also part of the focus for them.
Okay, great. That's all from me, guys. Thanks, and congrats on a good result.
Thank you. Our next question comes from the line of Andrew Gottsell from UBS. Please ask your question.
Oh, thanks very much, guys, and congrats on the result. A few of mine have been answered, but perhaps just focusing down on the hospital margins, obviously up year on year, a great outcome, I think 100 basis points or more. But just in terms of consecutive halves, it does look like it's paused, and obviously understand there's a seasonal effect, particularly in the second half. But I'm just trying to understand, to what extent that pause might have been the sort of the phasing effect of your brownfields and the disruption that comes with that. And I guess just trying to sort of tease out what you might have felt you've done underlying, just in terms of your cost out programs with costs and fund negotiations.
Yeah, Andrew, it's not a wildly different. There's not a major seasonal pattern to it, if you like. I think at any one point in time, we're at different phases of improvements, be it around case mix opportunities, be it about labour strategies, or be it about procurement and direct sourcing and the like. So I think if you look at the full year, what you see is a pretty strong sustained improvement. And then our margins get, mucked around by things like long service leave provisions and things that have nothing to do with those strategies as well. So obviously, the further down the track you go, there's still plenty of runway there in terms of margin improvements. Some of the initiatives are harder than others, but I think we're not seeing a slowing in the rate of improvement. I guess it does vary hospital to hospital, and as Robert's already articulated, a couple of hospitals are also navigating some building works at the same time.
Okay, great. So, I mean, probably my take out there is that there was some level of underlying margin improvement that's probably pushed down by the effect of those different events.
Yeah, correct.
And perhaps just a final one from me. Just Robert mentioned medical centres, a number of strategies. I guess probably a longer term view. I mean, do you see you've obviously retained those at the same time, getting rid of pathology. Do you see that as a growth area? With private health insurance funds marching on Canberra, I guess to sort of want to get involved there. Is that the sort of longer term view?
Yeah, look, I think it's interesting, potentially exciting time. So you've got the MBS review occurring right at the moment. You've got a freeze on a lot of items for the next year or two. You've got health funds wanting to do some more. You've got governments looking at prevention. So to be honest with you, I think it's a bit of a sit and wait. It's a good business for us. It has the potential to be able to be scaled up, and I think it provides a really good link depending on where the government lands on whether health funds are going to get at the front end or not. If they don't, then perhaps we can on their behalf. So I think, to be honest, I think we'll more of the same, grow the business that we've got organically, but we'll be watching some policy debates with great interest over the next 12 months.
And just just a quick follow-up to that. Are you sort of seeing, in terms of recruitment, are you seeing momentum in terms of growth and recruitment, or is that sort of awaiting your sort of strategy? And
to be honest, it gets back to location as much as anything. That in some of the centres, we've got more doctors than we need. At others, in the more sort of semi-regional, outer suburbs, there's still recruitment issues.
Okay. Terrific. Thank you very much.
Thank you. The next question comes from the line of Victor Windia from Citi. Please ask your question.
Yeah, thanks very much. Look, I just wanted to ask about prosthetics. In the Harper Review, they drew that out as something that they wanted to look at, the way the prosthetics list works. So I just wondered, in terms of revenue, what, if anything, does prosthetics devices contribute? And then what about at the profit line?
So the bottom line is we spend over 300 million on prosthesis. We are really, it's just a pass-through cost. We have not really chased any special arrangements because at the end of the day, it's surgeon choice and they have strong preferences across the range. I think it's inevitable when you look at if the government was to go to a sort of semi-tender or use more of a public hospital model, that there would be big savings to occur in prosthesis. That would have little or no impact on our bottom line because it's an area that we always thought the government and the health funds would and should target. But equally, we didn't want to take on the role of convincing 17,000 specialists to work at our hospitals which brands they should and shouldn't use because it would always be seen as having a commercial link. So, the more money that is saved from things like that, the more money that can be used elsewhere in the system. So we would be supportive of any review of prosthesis arrangements and how they're currently put in place.
Okay, thanks very much. And then just in terms of medical centres, you moved, I think you drew out the switch to a higher fee split model versus upfront payments. And, we've seen the, ATO agreements with primary. So I'm just wondering if there's anything there, or any of your doctors, getting adverse assessments or, is there some negotiation underway there or is that not an issue for you?
Our model has always been pretty simple in the sense that where we are in the situations that we have written a cheque to a doctor to either join or renew at a medical centre, we always amortise off that charge over the life of the contract. So we've never ever accumulated any medical centre goodwill on the balance sheet as a result of this practice. The punchline is that we prefer the model that goes down a fee split arrangement. From a net cash flow from a business perspective, we prefer that model. We still pay a modest amount in terms of checks, but we prefer the fee split model, and I think our result shows that benefit. And
most of the doctors who are signing are on that model.
Yeah.
Okay, but in terms of tail risk from previous arrangements, and impact to your doctors, you're not seeing any significant impact there?
No.
Okay, and then
our practice has been.
Yeah, that's great. And then in terms of the medical centre business overall, it's relatively small. What's your sort of strategy with that business, going forward versus, I guess, investment capacity in the brownfields and so on?
Look, I think I'll answer that in 12 months' time. We've got 2 or 3 government reviews happening. We've got health funds looking. We might partner with a health fund, do something different. We might decide to grow, or we might ultimately decide that it's non-core, but it's certainly not doing any damage. At the end of the day, it is a smaller business with a different sort of operating model. That's one that in the last 5 years we've managed successfully, We just chose not to grow because we wanted to put, well, one, it was, pathology was restricting the growth that we could pursue. And secondly, obviously, the focus was on the brownfields, and that sort of is now behind us, and we'll get a chance to have a proper look at medical centres in the next 6 to 12 months.
Okay, thanks very much.
Thank you. The next question comes from the line of David Leo from Deutsche Bank. Please ask your question.
Thanks. That's David Lowe from Deutsche Bank. Just, Robert, the CapEx in FY15 was a bit lower than I had expected. I was just wondering, what's the cause of that? Am I wrong? Or were there projects that now are a few months behind schedule?
Yeah, so the short answer, Dave, yes, it is a bit lower. It's a couple of things. So there were a couple of major projects there that in prospectus forecasting, very conservative on. So, Gold Coast will be built for less than what we budgeted for. Knox will be less than what we budgeted for. A couple of minor timing issues to do with, one, John Faulkner, we don't have a permit yet for the 40-odd beds. Holmes Glen's a couple of months out from its timeline, Norwest a couple of months out, but nothing's changed in terms of the forecasting. So a mixture of some minor timing differences and some conservatism in forecasting how much a project was going to cost.
Okay, great, thanks. And I didn't understand the answer to Dave Stanton's question on finance costs next year. Could you be a little bit more explicit as to how we should think about that, what that cost is going to be?
The short answer is, if you look at our pro forma interest cost for the current financial year, it will be very similar next year. And the reasons for that are, a lot of the interest on the big projects, Gold Coast and Northern Beaches, has been capitalised on the way through.
Yep.
And a lot of our brownfield developments are being funded from, obviously, we've got a fully drawn senior debt facility, but operating cash flows as well. So the sum of everything is that if the pro forma interest cost in 15-16 should be similar.
All right, that's loud and clear. Thank you. And Rob, just one for you. You made the comment during the briefing that there's a challenge to keep up the run rate in hospitals. I mean, my interpretation of that is it's going to be a challenge to match the growth that you saw in 15 and 16. Am I understanding that correctly?
No. My reference was to when the beds open and any disruption. So, we put the guidance out saying, we've got a bit of consistency in the last couple of years about what we're doing on the bottom line from the same. And that's probably where you should be thinking, this year, when you weigh up, we get 3 months of extra beds, less a month of very quiet downtime. When you sort of do the ins and outs around the openings and the disruptions, you'd probably get pretty similar year on year. I just think a couple of, we're getting feedback that sort of people were going to think it was going to be, full on day one, and there was never any disruption. So it was just a quiet. Certainly don't read this as a downgrade. I'm probably always delivered, as you know. And we're really excited over 17 and 18, but I just got to contain my excitement for another 6 months.
Okay. So, double-digit hospital growth in 15 can be achieved again in 16.
I think we're saying that will assume everything works well for us, but it won't be far off that if it's not.
All right. No, that's helpful. Thank you.
Thank you. The next question comes from the line of Chris Carlos from Morningstar. Please ask your question.
Good morning. Thank you for taking my question. Most of mine have been answered, but just a quick one for Robert on the international pathology. Robert, can you just clarify what kind of market share do you have in New Zealand, and is there scope for entering new geographies beyond the 3 that I mentioned?
Yeah, look, in New Zealand, we have 13 of the 20 DHBs, so the pathology is literally government funded over there.
Yep.
So I think in terms of market share, we roughly have about 55% 50-odd%
of the contestable.
Of the contestable market. So, probably the one thing is not much more we can win, to be honest with you. And the existing ones are locked in for a long time. So, there will be some slight growth, only because the growth has been driven by us continuing to win government contracts. Mm-hmm. In terms of Singapore and Malaysia, it's community pathology. So we literally do very little hospital pathology, and that's the opportunity. So in Singapore, obviously we could partner with a Raffles or an IHH, would be the two obvious ones, and set up a much bigger pathology. There's also some smaller, sort of revenue, $10, $20 million type of players up there that obviously, we could look at acquisitions, and the synergies in pathology over the years have certainly always been around 30 or 40%, so it would make a lot of sense for us to look at that. Malaysia is probably more of an exciting market for us because, again, there's probably a lot more of those $10, $20, $30 million type revenue standalone community pathology businesses that we could definitely integrate. We've got a small beachhead with one hospital operator in Vietnam, and obviously we keep a watching eye on Indonesia, where the management teams had previous experience. So I think they're the focus. Obviously, we get a phone call in China every second day, and we know that someone will get up there eventually, but I think we've got enough to do in our own backyard for the next year or two first.
Great. And just the last one on that point, in terms of acquisitions to expand that business, what kind of multiples are you comfortable with?
A lot less than those who may be interested in selling, prepared to want. There is a multiple issue, anything you look at in Asia. But because of the synergies, and we're not against JVs, not our preferred model. So we think we can come to some commercial arrangements that reflect the multiples that we are comfortable with, but equally give us operational control and allow us to deliver the synergies that will be needed to make this a really attractive acquisition for us.
Great. Thank you very much.
Thank you. The next question comes from the line of Will Dunlop from Merrill Lynch. Please ask your question.
Thank you. Just had one question. Just wondering if you're seeing any change in the competition for specialists amongst hospital operators at the moment, perhaps in any certain cities or amongst any certain specialties. Thank you.
I run a national or an international company, but I have to answer that on a location-by-location basis. So I think I've already indicated that Knox, North Park in Melbourne, Norwest, Nepean, Campbelltown, we've got a pretty dominant position, and it's usually co-located with a public hospital. So there's growth in the public hospital. I might use Campbelltown as an experience. They seem to open an extra 100 beds every 2 years. And obviously we keep expanding our Campbelltown private hospital, which was 60 beds, and now it's 110, and we want to go again. So we are sort of mirrored to the public hospitals in that co-location concept. In other markets where it's more fiercely contested, I might use Canberra. Competitors way before the Medibank dispute probably didn't do some things that we did in terms of capital, new services, and sessional rooms, quality of nursing staff. There's a whole range of reasons why a doctor would choose one over the other. But I don't think we're seeing any more movement than we have for the last 20 years, given that it's either a fiercely contested market where you'll get a bit of movement to more or less a solo market where you don't get a lot and all in between. I think that our strategy is the big hospitals will get bigger and the small will get smaller. This generation of doctors, everyone, if I come out, I want to go into a group practice, I want an ICU, I want a resident, I don't want to get rung overnight time. I don't want to work 100 hours a week. So when you look at the Norwest, the Knox and the PNs, they all offer backup for you as a specialist if you want to be a standalone one that you just don't get in the small one. So I do see a drift from small facilities to the larger ones, and I think that drift will accelerate as more and more females and lifestyle doctors get into the system.
Thank you.
Thank you. The next question comes from the line of Saul Hudson from Credit Suisse. Please ask your question.
Good morning, guys. Can you hear me?
Yep.
Great. Robert, can I maybe start with you? There's been a lot of discussion in the last few weeks about quality. Look, arguably as much of an issue would be private health insurance affordability, which you touched on. Can you talk to, with this rapid change to exclusion-type policies, cover buy-down, increased excess, etc., whether you're seeing any impact at all, particularly around very elective-type surgeries in terms of volumes, any impact on volume growth? Are patients delaying surgery because of those excesses and co-pays that they might incur? Thanks.
Short answer is no. I keep asking myself the same question, and it's difficult to get, because there's an exclusion where you elect to take a front-end deductible. So for $500, I reduce my premium, but I'm probably still happy to pay the $500, albeit reluctantly, versus I take an exclusion on obstetrics, orthopedics, cardiac. And there's very little data available on which specialties have had a rapid take-up in exclusions rather than front-end deductible. So I think the market is lacking a lot of data of what's happening at the health funds, and I suppose one of our wishes is that we see some of that. But at the front line, we're not seeing any decrease. I think the only specialty that I mentioned, and I think this is a 3-4 year trend, would be obstetrics, where the public hospitals offer more or less a no out-of-pocket experience, and several of the privates you would see $7,000 to $10,000 being common. So I think obstetrics would be the only area where I think people are slightly voting with their feet, but for the rest, the waiting list is still the gatekeeper, and what choice have you got? I could go, one health fund advertised a new product in February that called itself Top Hospital, and if you went, it excluded mental health, rehabilitation, cardiac and obstetrics, and I'm like, how can you promote that as Top Hospital? So there is a marketing amongst the health funds, which I think is further encouraging that. So it is a sleeper in the industry, but I don't think we've seen the impact come through yet.
Okay, thanks. And then maybe just moving back to the quality story. So now that the 165 measures have been put out, have you guys had the opportunity to quantify if, in fact, you were not paid for any of those 165 events, albeit the majority seem to be fractures from a fall, just what the dollar cost impact might be to you on a full year basis?
Look, if I'm talking to Medibank, it's 10%, and if I'm talking to the doctors, it's 0.1. Yeah, we have a number, but I'm not going to reveal that. Look, the bottom line is we disagree with that list, and that's why I've said before, we have our own list which we think reflects the definition between mistakes and ongoing clinical practice. If we were to accept that list, then I'd probably be asking Medibank for a pre-medical screening of all their members, and those with infections we'd send down the road. I don't think that's what they want. I don't think that's what their members want. So whilst the list was well-intentioned, the financial impact for us would be reasonably negligible under the current, current standards that we meet. But I think there's a principle here that, an agreed industry list that also applies to the public hospitals is the absolute way to go. So we take out the fact that whether Medibank's doing this from the goodness of their heart out of quality, or whether they're doing it as a guise for a fee cut. And to be honest with you, I think we have an agreement in place for quality, so I'd like to think it was quality. But I think the public criticism that they've got will be taken away if we can all sign up to that Australian Safety and Quality Council list that hopefully comes out in the next few months.
Sure. Okay, thanks for that, Robert. And just a couple of quick ones for Michael. Michael, just look at the statutory costs for full year 15 and how they relate to what you disclosed in your first half report regarding those cost lines. Am I right in that you can't actually use those first half cost lines? And if that's the case, can you talk to trends in second half regarding, in terms of that cost out that you saw, was it sort of consistent with the leverage you got in first half across those key line items such as employee expense? Thanks.
I'm not sure I've understood the question correctly. I think what we're saying is that there's been a fairly consistent trend of margin improvement in our results, if I'm understanding your question correctly. If you looked at our half one, half two result in terms of EBITDA growth or EBITDA margin improvement, particularly in hospitals, I think you're finding a fairly consistent trend there. But I'm not sure I've understood the question correctly if that's not the answer.
I might rephrase it. So are your first half costs in your statutory reports from the half consistent with how you've reported your costs for the full year?
Yes. Yes is the answer.
Because in that case, there does seem to be some...
There's no change in accounting policy or treatment or anything of that nature that's gone on. Because the only thing that is different is when you look at the group result, depending on which set of numbers you look at, obviously Australian Path is not part of the continuing businesses. So we do have a complex set of numbers between group and statutory and continuing. So that's the only caution I have on that.
Okay, I might take that one offline. And then, Michael, just one last question from me. Your net debt that you disclose in the presentation, I'm assuming that does not include the receivable securitisation. Can you just confirm that? And can you also just confirm what the average balance of that facility was during the year? I see the closing period was 113 million, but just can you give us an average number? Thanks.
Yeah, the year-end number is... so no, it's not part of that net debt number, and the second part is that it's a pretty consistent number. The number wouldn't vary by, let's say, more than $10 million month to month. So that number, 113 odd, is representative.
Great. Thanks a lot, guys. That's all I had.
Thank you. The next question comes from the line of Ian Albert from Goldman Sachs. Please ask your question.
Oh, good morning. Yeah, thank you for taking my question. Some of the health funds have talked about, we've talked about already about preventable events and quality of service, but they're also talking about differences in pricing for the same procedure at different hospitals within the same hospital group. I'm just wondering, is there much variance across the Healthscope group in pricing for the same procedure, and do you expect pricing to converge over time?
I should go up front. I think I've been public saying I don't think we're the highest paid. I can nearly prove we're the highest quality on the evidence that we see. So we actually would favour a standard price across the industry. Said that from day one. I mean, it's what happens in the public sector. But obviously there's a lot of history here, and a lot of the funds, and Michael's probably better placed than I to answer this, but historically there's been rate differences of 10% between like hospitals across groups and even sometimes within groups. So, and it goes to membership in local areas, the purchasing power of the hospital, the fund's dominance in that area. So there's a lot of history and there's a lot of variation. Any move to a standard pricing model, I would see us being a beneficiary of that model, and we would actually welcome it.
Yeah, the price schedules reflect historical negotiations over a long period of time, and sure, we'd like those prices to converge more, but there's some other realities. I think there's been press around that sort of suggests prices in Adelaide are less than everywhere else in Australia. That's probably true, but if you want to buy a PHI product, it's cheaper in Adelaide than anywhere else in Australia as well. So it's a complex picture.
Thanks. I suppose my question was more about variations within your group. There are major variations within Healthscope, and do you expect those variations to converge?
they're not wild variations, and I think
70% of our procedures are on a case-paid basis anyway. So there's less variation across case payment.
Great. Thank you very much.
Thank you. The next question comes from the line of Ray David from Schroders. Please ask your question.
Oh, hi guys. Just a question on page 20 of the presentation, the major projects. Could you just talk to, when do you expect these to come on by financial year? I think you talked about sort of 17 being sort of a better year for brownfields.
Yep.
Northern Beaches is due for completion Christmas 2018.
The Gold Coast private will be next March 16, Easter. Holmesglen in Victoria will be late 16, Christmas. Knox in Victoria, the theatres will open their beds will open this Christmas, but the whole project doesn't finish until March, April. Norwest is early 17, calendar year. And National Capital is
early 2016.
Is early 2016, over Christmas. Again, some works to allow that to open.
And Northern Beaches is obviously the public-private tender. Is that going to? I mean, the economics of that project is going to be materially different to your existing business.
It's a different business model, but underlying economics aren't any different. I think we've been quite transparent over the past couple of years, saying for every dollar of capital invested in a hospital project, typically would get not less than a 15% return on capital by year 3, and Northern Beaches doesn't differ to that KPI. So different model, yes. Return on capital, not really.
Okay, great. Thank you.
Thank you. And our last question comes from the line of Bruce Stew from CBA. Please ask your question.
Oh, hi guys. Just a real quick one. Just noticed, so you've got 45 hospitals now, including the one you've picked up, the La Trobe recently, 12 leased and 3 under the AHCAs. Are you seeing any constraints in your ability to grow, specifically sort of re-brownfields, given you have sort of a high proportion of leased facilities as a percentage of your overall hospital portfolio?
The short answer is no. We've got developments underway with leaseholds and freeholds. With the light landlord and the light lease, there's no reason. It's more a product, as Robert said, it's 45 hospitals, one at a time. It's all about location and ability to expand. So, but there's no restrictions that we're feeling as a result of the difference between leasehold and freehold.
I mean, the only two that we're constrained from the lease being part of the bigger public hospital campus would be Prince of Wales and Melbourne Private, and everyone wants those hospitals to be bigger, but they also want the public hospitals to be bigger, and there's a master plan that has to happen and a political commitment to allow us to do what we want, but combined with what the public hospitals want. So that's just proving to be a long political process. But both of those two hospitals could be double in size tomorrow and full.
Yeah, great, thanks.
Thank you. There are no further questions at this time. I would now like to hand the conference back to today's presenters. Please continue.
Thank you very much for taking the time, guys, and we obviously will catch up on investor roadshows and elsewhere, and thanks for your ongoing interest in the company.
Thank you, ladies and gentlemen. This concludes our conference call. We kindly ask you to disconnect and thank you for your participation.